It was July 2nd, 1997, a Wednesday morning in Bangkok. The Bank of Thailand had spent the spring burning through its reserves, 90% of them gone, trying to hold a line that markets had already decided to break. By 8 in the morning local time, the line was gone. The baht, pegged for over a decade, was floating, and by the end of the day, it had fallen by a fifth. This is what happened next, but the trouble had been visible 6 to 9 months earlier. To exactly one man in New York, reading the same numbers no one else wanted to read. To understand what broke in July of 1997, you need to understand what 1996 looked like. The Asian tigers, Thailand, South Korea, Indonesia, Malaysia, the Philippines, had spent 2 decades doing something the rest of the world struggled to do. They had compounded growth at 7, 8, 9% a year. They had moved tens of millions of people out of poverty and into a middle class that bought refrigerators, took vacations, and sent its children to university. The arrangement that made it possible was simple. Every tiger currency was pegged, quietly or loudly, to the US dollar. With the peg holding, local banks could borrow short-term dollars at American interest rates and lend long-term and local currency at Asian rates. The spread was the engine. As long as the peg held, the engine ran. By 1996, the engine was running hot. Thailand's trade deficit was widening. Real estate was overheating. The short-term foreign debt of Thai banks had crossed $109 billion, and the country's spendable reserves wouldn't cover even 3/4 of it. A few people in New York noticed. One of them ran a fund called Quantum. His name was George Soros. He had broken the Bank of England 5 years earlier. He had a war chest of $12 billion and a lead portfolio manager, Stanley Druckenmiller, who had been with him since 1988. And starting in early 97, Quantum began quietly building a short position in the Thai baht. The trade was simple. Quantum sold the baht forward, about $1 billion of notional, at maturities ranging from 6 months to a year. If the peg broke, the position printed money. If it held, the fund could roll the contracts or close them quietly. In May, the speculators came in waves. On the 14th and 15th of May, the Bank of Thailand was hit by what its own staff later described as an avalanche. The central bank fought back the way it had been fighting back all year, by intervening in the spot market and locking up its reserves in forward contracts. What the public couldn't see was that the reserves were already mostly spoken for. In July of 97, the official number was $30.4 billion. The number that mattered, the part not already committed to forward contracts, was about $1 billion. A country defending a currency peg with $1 billion of dry powder is not defending anything. It is performing a defense. On the 30th of June, Prime Minister Shavali Yongchayud stood in front of cameras and promised the public that the baht would not be devalued. 2 days later, on the morning of the 2nd of July, the Bank of Thailand announced a managed float. The baht fell 15 to 20% the same day. By the end of the week, the contagion reached Manila. The Philippine peso came under attack. So did the Malaysian ringgit. So did the rupiah. And Nane in New York, Druckenmiller was closing out the trade. Quantum made about $750 million on the Thai baht alone, a return north of 70% on a position that had existed for less than a year. Soros, as he had after Black Wednesday, said almost nothing in public. The currencies kept falling. To understand what happened next, you have to understand that the Asian tigers were not 5 separate stories. They were one story, told 5 times. Every tiger had the same setup. Peg currency, short-term dollar debt held by domestic banks, real estate booms financed by that debt, and foreign creditors who'd extended that credit on the same assumption, that the pegs would hold because they always had. When Thailand floated, the assumption died, and every creditor with exposure to a country that looked like Thailand, that is, every country in the region, began the same conversation at the same time. Pull the line, get the dollars back. The result, in textbook terms, was a self-fulfilling run. In Indonesia, the rupiah was floated on the 14th of August. 5 months earlier, you could buy $1 for 2,600 rupiah. By January of 98, you needed 14,800. In Jakarta, a generation of middle-class families watched the price of imported rice double, then triple, then disappear from the shelves. In Seoul, the math was even more brutal. By the third week of November 97, South Korea, the world's 11th largest economy, had less than $20 billion in reserves against over $100 billion in short-term foreign debt maturing within months. On the 21st of November, the South Korean government formally asked the International Monetary Fund for help. 12 days later, on the 3rd of December, the largest bailout in IMF history was signed, $58 billion in standby support. The conditions were what made it controversial. The IMF required Seoul to raise interest rates aggressively. On the 1st of December, the Bank of Korea's benchmark rate was 12.3%. By the 23rd of December, 22 days later, it was 30.1%. Korean firms with dollar debt watched their debt service explode. Daewoo Motor, one of the chaebols the IMF would later require Korea to dismantle, filed for bankruptcy within the year. Unemployment in South Korea more than tripled, from 2.05% to 6.96% in 18 months. The IMF prescribed the same medicine across the region. Cut spending, raise rates, let weak banks fail, allow exchange rates to find their level. Open the books. In every economy where the medicine was applied, the patient got sicker before getting better. The growth rate of Indonesian GDP went from plus 4.7% in 1997 to minus 13.1% in 98. Joseph Stiglitz, who had just stepped down as the World Bank's chief economist, watched all of this and said something out loud that the IMF wing of the building did not want said. He said the prescription was wrong. He said the Asian crisis called for stimulus, not austerity. He said in print, in books, later for a Nobel, that the IMF made a serious recession even deeper. By the spring of 98, 500 million people in Southeast Asia were poorer than they had been the year before. Indonesia was on the edge of political collapse, and in Kuala Lumpur, a 61-year-old prime minister had decided he'd had enough of the people he believed were responsible.
That's also why this episode is sponsored by my own private community. A private space where I break down over 100,000 deep dive courses, including investing, behavioral psychology, and cognition. The same fundamentals the people who saw the Asian crisis coming were reading 6 months out. If you've ever watched a single trader read a setup correctly and get blamed for the setup, the investing and psychology tracks inside go deeper into how that happens. Link is in the description below. Now, back to Kuala Lumpur and the Prime Minister who'd had enough.
In September of 97, 10 weeks after Thailand had floated, the International Monetary Fund and World Bank held their joint annual meetings. The venue, by coincidence, was Hong Kong. Mahathir Mohamad, Prime Minister of Malaysia since 1981, took the floor. He did not soften his message for the room. He called currency trading immoral. He demanded it be banned. He accused the people running hedge funds of trying to roll back decades of Asian development. He called Soros a moron, and then he went further. In remarks calibrated for his Malay Muslim political base back home, he blamed Jews, Soros among them, for the regional collapse. Soros was in the room. His response, given that same week, was 4 words. He said Mahathir was a menace to his own country. For the next 12 months, Mahathir's Malaysia would prove him right and wrong simultaneously. In 1998, while every other tiger took the IMF's medicine, Mahathir refused it. On the 1st of September of 98, he announced something the orthodox economic profession of the time considered heretical: capital controls. He pegged the ringgit at 3.80 to the dollar. He banned foreign investors from repatriating funds for at least 12 months. He made it operationally impossible for a hedge fund to short his currency. The next day, he fired his deputy prime minister and finance minister, Anwar Ibrahim, the man who had been arguing for the IMF approach. Anwar was expelled from the ruling party within 48 hours. Months later, he was tried and jailed. In Indonesia, the political payoff was even larger. After months of food shortages, the rupiah at 14,800 to the dollar, and bloody student protests, Suharto, 32 years in power, resigned on the 21st of May, 1998. And in August of that same year, Soros tried Mahathir's neighborhood one more time. He came at Hong Kong's currency board with what the speculators called a double play. Short the Hong Kong dollar in spot. Short the Hang Seng index in futures. If the Hong Kong Monetary Authority defended the peg by raising rates, the stock market would crash and the futures short would win. If they let the peg go, the spot short would win. The HKMA, under Donald Tsang, did what no advanced economy central bank had done in living memory. It went into the equity market directly. Over 2 weeks in August of 98, the HKMA bought $15 billion of Hong Kong stocks and futures. The speculators were forced to close at a loss. Soros himself, 3 years later, acknowledged that the Hong Kong authorities had done a very good job. It was the first time since 1992, since the Bank of England, that he had been clearly stopped. Step back from the people and look at the system. The Asian crisis was not caused by George Soros. It was not caused by hedge funds. It was caused by a structural setup, quasi-fixed exchange rates layered over a short-term foreign currency set that was guaranteed to produce a crisis the moment foreign creditors reassessed their assumptions. The international community would eventually mobilize roughly $118 billion in rescue packages for Thailand, Indonesia, and Korea combined. That's what the official ledger shows. What the ledger doesn't show is the capital that left the region in the same period. The Federal Reserve Chairman of the day, Alan Greenspan, told the United States Senate in January of 98 that foreign investors in Asian equities had lost roughly $700 billion outside Japan. Soros had read the setup correctly, the same way Michael Burry would read subprime 8 years later. The trouble could be seen 6 to 9 months out. The pegs were inconsistent with the trade deficits. The capital inflows that closed the gap were not sustainable. None of this required inside information. It required the willingness to read what the central banks were publishing. But reading the setup correctly does not make a man responsible for the setup. What Soros and Druckenmiller did was take a position. What the Bank of Thailand had done, and what the Bank of Korea and Bank Indonesia and Bank Negara Malaysia had done, was build a system that could be taken. Mahathir needed a villain, because the alternative was admitting that his region's economic miracle had been built on borrowed dollars at borrowed time. Soros made a convenient one. He was not the cause. He was the alarm. The deeper question this episode raises is what counts as a market working correctly. The IMF wing of the orthodoxy in 1997 held that the crisis was a failure of crony capitalism, banks lending to friends of the regime, regulators looking the other way. The medicine, in their view, was the medicine you give a corrupt patient: cut, raise, discipline. The Asian tigers had grown up. It was time for them to behave like adult economies. Stiglitz, in his book Afterwards, argued the opposite. The crisis, in his view, was not a punishment to be administered. It was a liquidity panic to be calmed. An imposing fiscal contraction in the middle of a liquidity panic was, in his words, like prescribing a diet to a patient bleeding out. History gave both men some of what they wanted. By 2010, 12 years after Mahathir was called a heretic for imposing capital controls, the IMF formally accepted that capital controls were a legitimate macroprudential tool. The heresy became orthodoxy, and by 2001, the Korean economy had repaid the IMF loan in full ahead of schedule. So, which one of them was right? The answer is probably neither and both. Mahathir was vindicated by the IMF's later reversal, but wrong about who was responsible. Stiglitz was vindicated about the medicine, but underrated the genuine local governance failures that had made the patient sick in the first place. Soros was vindicated by the trade, but used as a target for everything the trade exposed. The market did what markets do. The people who survived best were the people who took the data seriously, didn't moralize about who was deserving, and stayed liquid enough to act when the run came. It is July of 1997 again, just for a moment. The Bank of Thailand has just floated the baht. In Hong Kong, the annual meetings are still 10 weeks away. Mahathir has not yet said moron. Suharto is still in power. The Korean won is still trading near 900 to the dollar. The single trader in New York is closing out his position quietly. The next 18 months will rewrite the region, politically, economically, generationally. 500 million people will be poorer. A 32-year regime will fall. The orthodoxy of the IMF will be challenged from inside the World Bank. And somewhere in London, a different hedge fund is running models that say something even more unsettling about what 1998 is going to do to leverage. That story, the one that breaks the model that almost broke the financial system, is the next episode. Every market has its legends. Subscribe so the next one finds you.